Okay, everyone, thank you for coming back. Welcome back for the final session of today, the final session before drinks and dinner. And this session, our fifth session, is on financial regulation and the environment, risk, resilience and opportunity. We have four very distinguished supervisors and financial regulators representing different jurisdictions here to speak about those issues. Jean Boissinot from the French government couldn't come, unfortunately, and sends his apologies, the family matter last night, but we had four speakers. So I'm going to hand over to Gisella from DNB to kick off, and we will go down, and then we'll open it up and have hopefully a very interactive session.
Thank you, Ben. The last speaker of the last panel ended with saying that the financial regulation cannot solve everything, and I guess that is very true, nor can regulators, supervisors or central banks. But of course there's something we can do, and that's what I would like to share with you, what we are doing. For starters, we just launched a network which was referred to earlier, the Central Banks and Supervisors Network for Greening the Financial System, with also our colleagues from the Bank of England, Banque de France, and we are organizing a conference in April to discuss how we move forward on this subject. One of the areas we are continuously discussing as a supervisor is actually what is our role in the discussion on sustainable finance. And that's not always an easy one. That's a continuous debate, internally but also externally. We do believe that if our aim is aiming for financial stability, that it makes sense to take sustainability into account if you want to have financial stability. So that's where we come from in our mission. Even with the current regulation, we can do actually a lot as a supervisor to have some investigations in the financial sector when it comes to sustainability. For instance, we are developing a stress test from financial stability. We are creating scenarios, and I was just discussing with somebody from the audience, how do you do that? And I think that it's a very difficult task to create a stress test, but in the end, it's not about having all the right scenarios, but it's a starting point for creating scenarios, see what the effects may be in a top-down stress test on the financial sector, and then learn from what we see there. And the learning part is not what we do ourselves, but also to share that with the financial sector as well. So that's one thing we are creating as the Dutch Central Bank. We also supervise pension funds. And a couple of years ago, we started to ask the pension funds to become far more transparent and to report what they actually do on sustainable investments. And a very interesting thing happened there. There were pension funds which were definitely front runner in doing sustainable investments. And then you get kind of a competition. So you see that creating transparency in the market, which we can ask for in the current regulations, that creates already a lot of movement in the sector. So they have to now be transparent on if they integrate sustainable finance in their investment goals, how they manage that. And what you see happening is that participants in the pension schemes want to know how their money is invested. So they're even pushing forward. So one of the biggest pension funds in the Netherlands was recently moved out of investments in tobacco because simply the participants in the pension funds didn't want that with their money. So by simply creating transparency as a supervisor, you can create a whole, let's say, chain of reactions in the sector. Another thing we did was looking at banks. If you look at banks and the loan book, they have commercial real estate, and real estate in general play a big role there in direct loans, but also as collateral. Real estate usually has energy labels, and in the Netherlands it is not allowed to use commercial real estate or real estate with an energy label worse than C, which means if that's a collateral on your balance sheet, then it's, well, it's not useless, but it becomes maybe a lot less worth. So we started asking the banks whether they knew what actually the energy label was for their real estate portfolios. And in many cases they didn't, and so we didn't. So the risk involved in this whole regulation change was not known to the banks and also not known to us. So what you do then is by asking the questions, which you can simply do based on your current regulations, your current mandate, creates already a complete chain reaction. What you see now banks doing in the Netherlands is that the whole refinancing process gets a lot more difficult. If the energy label of your real estate part is D or E, well, you can't have it refinanced just like that. So the banks are forcing the owners to create a better energy label, and so you can influence the whole chain. So those are some examples of what the Dutch Central Bank is currently doing. It's not easy. I think we are kind of, well, experimenting here and there, but it goes for all of us. And it's, I think, interesting to do that together with other supervisors and central banks, but also with the whole financial sector.
Great, thank you very much. Matt?
Great. Thank you, Gisella, and we obviously very much welcome the chance to be part of the network under DNB's chair, Frank Alderson, and also a pleasure to be co-organising the conference that's taken place on April the 6th, both with DNB and ACPR, the French prudential regulator. And I think it's a sign of the growing recognition of climate risk and the relevance to supervisors, which are certainly, I think, having been involved with the bank's work for about 3 or 4 years now, definitely seen an increasing recognition of these issues, and I think the conference and the network is a good sign of that. In terms of my opening remarks, I thought I would just set out, for those of you who may not be aware, why the Bank of England is interested in these issues, and to bring you more up to speed with what we're doing to respond to climate change and related risks. And then maybe 1 or 2 observations to finish. So on the first of those, the reason that we are looking at climate change is that because we see it as a financial risk, quite clearly, not only climate change, but obviously society's responses to climate change, which speaks to the framework that probably many of you may already be familiar with in terms of the physical risks of climate, storms and floods, and then also the transition risks that can come from adjustments towards a lower carbon economy, and then relevant to the insurance sector liability type risks, which obviously could also have some broader relevance too. And I think importantly we see these as financial risks that are important today. So examples of insured losses increasing, and for specific events such as Superstorm Sandy, clear evidence that, for example, the 20 centimetre rise in sea levels led to increased insurance losses for Superstorm Sandy. So evidence that these are financial risks today, and then obviously also looking forward, the fact that these financial risks can increase. So the way that we therefore respond to these risks is very much through the prism of our objectives. So our work started, as some of you might be familiar with, looking at the insurance industry. So obviously particularly the general insurance industry on the front line of managing the risks of storms and floods. And then with the sort of recognition of the transitional impacts that could have, that's one of the reasons, I guess, that we now have a broader range of activities. So the bank's work is structured around 2 pillars. So we have a prudential pillar, which, as well as continuing work in insurance, and 1 or 2 of my insurance colleagues are here, we also have undertaken a review of climate-related risks to the banking sector. So that's on the prudential side. So how can we ensure that we're promoting the safety and soundness of firms by considering climate-related risks? And then we have a second pillar which speaks more to the systemic risks of climate change. So as the Governor and many others have talked about, the possible financial stability risks that can come from a late and abrupt transition, and what we can do as a central bank and as a supervisor to support an orderly transition. So it's already been discussed today. Obviously, financial regulation, central banking is not the answer to everything, but there are things that can be done to support an orderly transition. A lot of the activities we're doing underneath that second pillar are almost naturally quite international in nature, given the interconnected nature of the issue. So as well as the recently formed network, previous to that, one of the recommendations of the insurance report was setting up a sustainable insurance forum for insurance regulators to talk about these issues. That now has multiple members across different jurisdictions across the world. We've also been co-chairing the G20's Green Finance Study Group, which is now called the Sustainable Finance Study Group with the People's Bank of China, and obviously staying close to the TCFD recommendations, which no doubt we may touch on throughout the panel. So hopefully that gives you a little bit of introduction of why at the Bank of England we've been looking at these issues, what we're doing in response to that. Just in terms of one or two brief observations, I think it's been interesting to see as the bank's work has progressed, we have been also looking at sort of new ways of working. So one of the examples of that would be the way we organize the bank's work is that we now have a climate hub, which I have the pleasure to lead, and then we have a number of teams across the bank in different functional areas, so spokes, if you like, of that hub and spoke model. So some in insurance, banking, supervision, research, international, etc. So I think one of the big themes of today for me has been one of innovation. So I think we are also looking, at how we work differently or look at ways that we can coordinate our work at the bank. And also a big theme of today, obviously collaboration, and that's something that we are doing and actively with our other central banks. So hopefully that's helpful to set things out, and over to Rupert.
Thank you, Matt.
Well, thank you very much. And in my few remarks, I would like to give you some sense where we stand in Switzerland when it comes to greening the financial system, and also what is our role, FINMA's role as a supervisor in this respect. And I think I can also give maybe a non-EU, non-EEA European perspective here without getting maybe too much into political territory and discuss whether this is a good or a bad thing. But speaking for FINMA, I think it's important that we operate under a broader framework that is defined by some political and also societal preferences. And in terms of environmental policy in Switzerland, the government has set out some clear principles that are also relevant for us in our work. And one principle is that any solution to climate risk should be as market consistent as possible, and the government should take rather a subsidiary role where the market is not working or where market failures exist. And in these cases, if there's state intervention, then the public policies should address the market failure and the problem as directly as possible. So preferably by the use of taxes or subsidiaries, for example. Now maybe moving more closely to the financial regulation in our role. I think sustainability, or the issue of sustainability, has been thought of first in terms actually of financial stability, the financial stability of individual firms, of the financial system as a whole, but also as conduct or avoiding misconduct, which is certainly against the principle of sustainable business activities. And I think that these objectives are still at the core of our mandate, FINMA's mandate as a prudential but also as a conduct regulator. And this certainly has some link also to the broader discussion about financial stability, because only a financial system that is really working can provide the core economic function of allocating the capital efficiently. And when you think about misconduct cases, for example, in the area of corruption and AML, anti-money laundering, we see some high-profile cases where, for example, money that was should have been used for development purposes public money has been channeled through the financial system for illicit purposes. So there is a link certainly to the broader discussion of sustainability. And now this broader concept of sustainability, I think this is a rather recent development or objective for us, but the discussion has developed quite quickly also in the international area. And maybe I would like to talk about three different aspects here. One is sustainability and financial risk. The second one would be green finance. And the last one, the third one, would be about what I call green regulation. And let's start with the risks. And here I can certainly build on what the Bank of England has done and what has been mentioned before. I think we share this analysis that there is important financial risk involved in this discussion about climate change. And also these category of risk, I think physical risk, transition risk, repricing risk of assets, we would also agree on this. And those risks, I think they translate into quite well-known categories of credit risk, of market risk, and our regulatory but also our supervisory approaches, I think, have been quite well tested in this regard. So we would certainly apply those approaches, and this means in particular a proper risk management by the financial firms, stress testing, making sure that those risks are really addressed. And our role here is, I would say, is more a secondary role. It remains the primary responsibility of the management of a firm to handle these risks. But we see it as our job really to raise the awareness for this and also to second guess the conclusions of firms. And this means we have this discussion in our supervisory dialogue. We look at the scenarios that are, for example, used in those stress tests by the firms, and we really engage in such a discussion. Then maybe coming to the next point, the green finance, and this is the question what the financial system can contribute actually to sustainable development. And I think I can remain rather short because there is certainly an important role. Banks, insurance companies, pension funds as long-term investors, they have a potential. But also the financial system as an intermediary and some agents in the system like rating agencies, stock exchanges, they can have an important role to achieve this goal. And maybe then coming to the third aspect, what I would call green regulation, and the question, should you use financial regulation as a tool or an instrument actually to further this broader sustainability objective? And I think our position here as a regulator, where we have a competence to regulate, is that certainly our regulation should not be a barrier to sustainable developments. And this is a very important, I think, general principle which also applies to, for example, financial technology, where the regulation is not justified and is a barrier to such developments. We should actually remove these barriers. Then maybe the next step, I think there we would be a little bit more cautious. We think that financial regulation should really follow or should address the objective of financial stability and financial soundness of firms. And it's probably not the best idea economically to try to have other objectives built in this regulatory system. So, for example, you would create some important trade-offs if you would have artificially lower capital requirements actually to mobilize some funding for a certain purpose. We think that would be not sound in terms of financial regulation. And from our discussion with banks and insurance companies, we also understand that actually capital requirements today are not really a barrier or a problem when it comes, for example, to long-term finance. So if there are projects for long-term finance and also for green finance that are economically sound, I think that they are much looked after by the financial sector, in particular in terms of this search for yield environment. So maybe to conclude, I think for both for the Swiss government but also for FINMA, this topic is certainly very important. And we see not only risks but also opportunities for the financial industry. And so far we think that some of the private sector activities or initiatives, they are quite encouraging, but there's certainly a lot more to be done, and I think we as a regulator, we have a role here to play.
Great, thank you, Rupert. Over to you, Leena.
Thank you, Ben, and thank you, organizers, for inviting me here. I think we are, what I find particularly interesting and why it's so fascinating to discuss this topic is that this is the biggest ever systemic risk that we've confronted. I'm a big science fiction fan, and I always remember the Matrix film where you have a sort of chance of choosing the blue pill or the red pill. And the red pill is the truth, and you know what the world is really about, and you are sort of in trouble because you try to solve things, but you can always choose the blue pill as well and get away with it and forget about everything and just live your life as it were easy. Actually, we've all swallowed now the red pill. We know where this is going, and it doesn't look good. Now, looking at the financial sector and looking at the systemic risk that it has caused to itself, how fragile the system became, and what was revealed to us in the crisis. I have a background in central banking and financial stability issues, so I studied it closely and actually worked for a private sector bank when the crisis hit the fan. And all of a sudden realizing that the market is not able to price the systemic risk was quite a shock. But I think pricing the systemic risk that is caused by the financial sector, it's a lot less demanding than trying to price this one. So this is, as I said, biggest challenge ever. Now, pricing the systemic risk from the financial sector, we just remove the risk weights that are zero from the governments, and everything else follows, because risks are correlated. But this is a trickier thing, because it has a very sort of a long-term impact. It may manifest very late, and we don't know those links. We can study the links between banks. We can see the correlations even. We don't necessarily get it right, even when we stress test it. But we have a lot more information about the links between banks and the financial system than we have about the environmental impact of what people are doing at the moment. But nonetheless, because now we all have swallowed the red pill, we just have to continue doing this, and it's going to be tricky. Now, I'm happy to be the last speaker because I'm the regulator. And these people, my colleagues, are supervisors. They, unfortunately, will have to deal with this already. However, we have the luxury always as regulation to take a look, sit back and look, what should we do? And that's what's troubling me, because I'm not quite clear yet where to hit. Because as I said, with the financial stability issues, trying to build a banking union at the moment and having these difficult debates in EU on this topic, particularly the euro area countries, I've realized that actually it is very much about political will as well. We can actually probably correct the systemic faults that are in the system at the moment on the financial side, but do we dare to do it? Would we be happy to remove the zero risk weight from the government debt? Would we be happy to allow governments to fail, to take an impact? And this has a similar sort of tone to it, this ring to it, this huge environmental issue that it's extremely political. I've started to study in my head the taxonomy that we've been discussing in EU quite a bit, because you have to base it somehow on data when you start attaching different sort of requirements for different entities. And let's think that we were to have, for example, green supporting factors that would lower the risk weight for particular projects. How would you go about doing that in Europe when every single country has their own preferred strategic industries that they want to support? So the politics of this are so humongous that I think those are going to be the biggest obstacles. Not that we don't know that there are risks and we should tackle them, but to avoid the fact that it gets so politicized that we lose the sort of dynamism that is built within it. And now that we try to build something that should be technologically neutral, for example, thinking about these tools that we are trying to implement, and would quickly move in time and allow disruptive innovations that would change the way we function, there are so many vested interests involved, it's going to be extremely challenging. And that's why nobody should sleep with this thing. Everybody should be awake and should work on it, but I don't think we get it right quite quickly. I think we have to take a couple of rounds of studying this and collect as much data and make everything so transparent as we can. Thank you.
Great, thank you. So 4 provocative interventions, I suppose, introductory remarks. I want this panel to be very interactive, and so I hope you guys will be accommodating and jump in with questions and thoughts, because this is a very interesting, very important area. And of course, regulators and well, both regulators and supervisors, but particularly supervisors, are going to be, as you heard a bit, and as we hear throughout these sort of proceedings, they're rightly a bit of a conservative bunch as well. So there's sort of a question of pushing a bit. So thoughts, comments, interventions? Yes, Sophia.
The importance. The question is directed to this question about financial stability and the role of the supervisory authority being, or your authority being responsible for that. And it's just to ask you, do you share the view that's held by the Bank of England about the fact that climate change does pose a systemic risk? And if so, how does that then square with your comment about the responsibility for stability? And then my observation was to Leena, if you don't mind me calling you that, which was, are there lessons to be learnt from health and how the politics of healthcare have been managed within Europe? Because there's been a really interesting kind of a lot of political energy gone into what is a member state competency and what's not, and how, and that, it's an uneasy agreement, but it's an agreement that works and it holds, and the balance between individual member state responsibility and what is European seems to have worked quite well. So I just wonder whether there are maybe healthcare or maybe other areas where there's lessons to be learnt.
So Rupert, do you want to go first?
Sure. So I think we very much share the analysis and the assessment of the Bank of England that there are, for example, physical risks, that are repricing risks in some assets or even in some firms whose activity is related to areas where potentially new regulation will limit those activities. I'm not sure whether I would say this is a systemic risk in itself. We think that the current or the existing and well-known categories that are enshrined in our regulations, or market risk, credit risk, they should already capture those risks. The question is more whether the financial firms they have a proper understanding, and if they are assessing these risks properly. And then we think it's the primary responsibility of the management, like in any other areas of risks, be it credit risk, market risk, legal risks. But we as a supervisor, of course, we have to have an own opinion. We have to second guess. We have to look at the processes, the models, the methodologies that are applied. And that's actually what we are doing.
So before passing over to Leena, I want to ask the other supervisors, Matt and Gisella, do you agree with that response? Do you share the same position?
Well, I guess we do. The only thing is what we do based upon that opinion might be slightly different. I think what we do is ask questions to the financial sector. I think credit risk is a good area to look for if you look at climate risk for banks. So if you ask banks, how do you take climate risk into account in your loan book, and can you explain that to me, then they start to do the work, because I fully agree the banks in this case should own this issue, but we are supervising them. So asking those questions is, I think, a very legitimate one. And usually our financial sector responds to those questions fairly positive, because they also do acknowledge that these are issues. So I think our position is the same, but how we handle that might be slightly different.
Matt, do you?
Yeah, I think we definitely share the thinking that climate change is not necessarily a new risk. It does show up in terms of different categories of financial risk. So obviously it translates in terms of credit risk or market risk or some of the legal liability risks that you mentioned. I think, as I outlined at the start, we do see the sort of forward-looking systemic risks to be coming from the transition, and obviously the longer-term physical impacts. And obviously within that, there's a whole question of time horizons and how can you bring those longer-term risks into decision-making today. I think one of the innovations, obviously, that is getting momentum through the TCFD recommendations around climate scenarios, I think is an interesting way to get greater visibility over some of those longer term risks and the risks of tomorrow and how we can, again, integrate that into decision making today. So I think advancing analytical techniques and data to enable us to get a clearer view of the risks is going to be important and require the collaboration of many different sectors.
I'm sure we'll come back to that. Leena.
Thank you. Just to comment on the systemic risk issue, it's just, the systemic risk can be credit risk as well. The question is how it's transmitted through the system and how it accumulates. And this definitely has those features, but the time horizon may be very challenging. And of course, we don't know the interactions yet. So I think the systemic risk within the financial sector is, if you can call it that, easier than this is. So this is so challenging, but so important. Now, it's an extremely interesting point whether it would be easier for the politicians if they sort of learned what we have done already in terms of what has been done on the healthcare side. It may be easier on that particular topic to deal with it as well because the voters are very close there. It may be less difficult as politicians to agree, but definitely it's worthwhile to take a look whether there's something to learn from the way to coordinate. I think the biggest problem at the moment is that we are in this sort of postmodern hell, basically, where we don't, I'm an economist by background, I really can't say what the growth potential of the system is. And just my central bank friends probably, hopefully excuse or forgive me for saying it, but the central bank policy as well has caused quite a bit of difficulty in saying what's the value of what asset, because there's so much liquidity going on and round. So then there is this pricing problem, and at the same time you have a problem of whether you believe a secular stagnation story, that nothing will grow ever again. And when you put these together, it gets very quickly very political when you think that the cake doesn't grow. It actually may stay this size or get smaller, then we start fighting amongst ourselves. When you believe that it's going to grow for everybody, you don't fight for the share so much because everybody gets enough. So I think this increases that political stress here, particularly on these strategic issues. You have the industries that sort of bring you the GDP. Now, whether you are willing to call them brown or green, everybody hopes that they have all the green sectors, but they don't. I think that's where the politics gets so difficult.
Postmodern hell. Don't want to go there. Okay, Chris at the back.
Hi, I'm going to ask Chris Barrett from the European Climate Foundation. I'm going to ask this question partly because Ben encouraged me to, so it's his fault, and secondly because you're only young once. My question is, I heard what Matthew said, I heard what Rupert said about, the green supporting factor and, lowering capital requirements for green investments and his scepticism around that, and I probably share it. But what I want to ask is the flip side of that, because I also heard Matthew talk about, well, we recognise these risks exist. So therefore, I'd like some views, at least on a theoretical level, to make it easier for you to answer, would a Brown penalising factor align risks in the system better with the kinds of measures that a central bank can take?
I think you might all have good, well-rehearsed answers to that, maybe. Matt, do you want to go first?
I think we probably point to the EC high-level expert group thinking, obviously, that there's wording in there around prudential requirements and the importance of ensuring that there's a safe and sound financial system, obviously, to ensure the transition. I think some of the questions and the areas of debate are obviously around data. So, if there's, just like any other risk issue, if there's data out there, then there's mechanisms within the prudential framework to consider financial risk. So I think that, again, comes back to some of the common themes of the day around the importance of having data and analytical models to understand these risks.
Just to comment on these penalizing and supporting factors, effectively, I guess what we are discussing when we are discussing the supporting factors is that we would like to have some sort of a green subsidy established. But I think the first thing to move before we go into greens, first thing, I don't know if it's the first thing, but the one thing that we definitely have to remove before we go into brown penalizing factors is the brown subsidies that we have in place as governments. Now, if you try to clean the sort of financial sector, try to force it to function in a particular way, and at the same time everything else remains the same, then we've sort of swallowed the green pill, thinking that we can just by ceteris paribus correct some of the system and then everything else we can forget about it and let the policy be there. I think what makes this so difficult, this is not only about sustainable finance, this is extremely systemic, and it has to have those other policy areas covered as well. So the brown subsidies should be removed as well before we even go to thinking about brown penalizing factors.
Does anyone else want to come in on this point?
Well, yes, in the ideal world, you should measure the risk and you need data, etc. So that would be the ideal situation. But we are not there for the coming years, I would assume. That takes a while before we get there together. So if you have to choose between penalizing or supporting, then I think you should look at the risks. If you are really feeling that green investments are overpriced, then that would make sense. I think the argument would be the other way around, that assets which are called brown are maybe not priced into the risks we are seeing because they are far away. So that would go the argument for, I think, a brown penalizing factor. I think what is very important, if you would go in this direction, do first a taxonomy and then discuss these factors, because otherwise it becomes a really messy process.
And do you think there's, I mean, certainly with the conversations I've had with market participants, is that particularly in Europe, you know, there is a bit of frothiness in green assets because there's a lot of money chasing not very many assets. So this would presumably make it worse, right? Okay. Okay. There were a couple of questions over there. Yes?
Thank you. Emily Mazzacurati with 427. You mentioned physical risk and the issue with data, and I wanted to hear your thoughts. When it comes to understanding physical risk in financial portfolios and bank portfolios in particular, you need to understand where the underlying assets owned by the corporations are located very specifically. You can't do a climate risk assessment if you just have country information, which is usually what banks have, if that. And that's one of the things that's been highlighted by the TCFD and the need for better disclosures. So from where you sit in your institutions, what do you think can be done to improve significantly and rapidly the level of disclosures by corporations on the exposure to physical risk on their physical assets? Thank you.
Who wants to go first? Rupert, you had a willing shrug.
Yes. So I think you already mentioned the international work going on, and we think as a, Finland, we think that the FSB work or this sort of best practice that has been developed is a very important and helpful first step. And at least when we look at the Swiss participants or the Swiss industry, they were quite active in this group. They are also supporting the implementation. The harder question is certainly, should this be mandatory? And when should the government step in? Do we rely on best practices? Is that working, or should we have a mandatory and binding rule? And I think, at least speaking for the Swiss position, it's too early actually to judge whether the private initiatives bring the right result. They are encouraging first results and improvements, but so far I think it's not yet decided, and probably there should be then an international standard and cooperation, because it doesn't make sense to have different national systems.
I think, for example, the Sustainable Stock Exchange initiative by the UN has been extremely helpful, and it's clearly generated transparency with the companies that are listed. Now, we already see some evidence, and I wonder what it's evidence of. I can't say what the causality of the thing is, but we seem to already have some evidence that those indices that are based on the green entities or green companies are performing slightly better in the stock market than others. Now it may be that they're more scarce as well and the price is increasing quicker. I also heard from, and I'm asking now the professors in Finland to collect the data for our use as well, whether we've already gotten rid of this phenomenon that before, when company announced sort of a green investment that had a very long-term impact, but the profits or potential profits came, way, way in the future. Actually, the stock price took a hit. But now, supposedly, I heard that there is already evidence that it doesn't happen anymore to the extent that there may already be a positive effect. Now, from a taxpayer's point of view, we don't really care if the market participants, if investors, they believe in it and they invest in a company and the price gets higher because of that, they believe in it. If they are willing to carry that risk themselves. Our worry is, of course, if it's built into a bubble and somehow spreads through the financial sector and hits the taxpayer. So that's the balance with the financial stability risk and the banking sector being sort of in the middle of it. But so far, when it's really market-based, when the investor and the company meet each other, they should be free to set the price, and the transparency should be there for them to do it. I think we see some good indicators that this is happening. I'm more iffy or more sort of careful on the side of the banking side, because that's a trickier, that's a debt side, and that transmits through the whole system to the taxpayer as well, whether more can be done there, and there we come to the supervisor's role, which is extremely important because they already have the tools. But how to measure things and say, do this, because once you start ticking the box and telling you're fine if you do this, you take the brain out of the financial sector and then they blame you when it blows up. So it's better to keep the responsibility with the guys who have it. So I have high respect for the supervisors at the moment, now that they're trying to devise the tools to guide the banks to start pricing this correctly on the debt financing side.
So I think we'll certainly have more questions on your capabilities and how you're developing them, but just one kind of question following on from that one about the TCFD. To what extent is the TCFD actually useful in terms of the disclosures it provides and how useful they are for supervisory practice? Because obviously, I mean, we kind of overlay so many things onto the TCFD as if it's a sort of panacea to everything, but actually it seems to me it wasn't designed for that purpose. Any thoughts?
Yeah, so in terms of TCFD, I think it's obviously early stages. So the voluntary response to it has been very strong, as we've seen. So something like $6.5 trillion of market cap of 250 companies, and I think something like $80 trillion of assets. So, I think there's clearly momentum there. I think we are in early stages. I think there's a number of sort of preparer forums that come together across different sectors, and I think the TCFD implementation report later this year will sort of give further insights. I think there's an element of clearly in terms of our conversations with insurance firms and also banks, where the TCFD recommendations are not just around the data side of things, they're also around governance and strategy. So, I think that is elevating the conversation, and we are seeing, I think, a sort of a transition in thinking that's happening around climate change being seen less as as well as more of a corporate sustainability issue, also a real financial risk. I think along with disclosures, I think there's also interesting areas of innovation, and it speaks to some of the questions around the physical risks that are happening in terms of asset level data. So obviously welcome the initiative that Oxford and others are running, and the focus of the G20 work that we did with China underneath the German presidency was how to look at more publicly available environmental data. So I think there's a lot of data out there that will also inform supervisory judgment.
Rupert, do you want to come in? No? Okay. Okay. Bob?
Thank you. Sort of a follow-up question to that. One of my frustrations with TCFD, and even more so with the high-level expert group document, was extensive discussion of disclosure and virtually, not much on materiality in the TCFD and virtually nothing on materiality in the high-level document, which I thought was odd because the accounting firms have actually been writing up a storm on materiality over the last decade, and Deloitte's done 3 or 4 papers on how we may need to reassess this whole concept. So I'm just wondering to what extent that discussion has entered the central bank dialogue around these issues. Has there been any, what thought, what attention has actually been given to, do we need to rethink this concept, or we just want to rely on what exists now and hope that it kind of seeps up?
Great question. Who wants to go first? Yeah, materiality. Does it need to be...
summarize your points again, or your question again. Sorry.
Well, the question is, have central banks rethought what they expect to see from the banking system on the issue of what the banking system regards as being material? So, there's a lot of talk about greater disclosure of climate risks, but who assesses whether or not those risks are material? We've got traditional accounting assessments of, if it's going to have an impact or something, but we know that the horizon issue keeps coming up as well. So has this issue of materiality been thought about at all in terms of what you expect to see being reported from the banking system?
So in terms of the disclosures the banking system is looking to make? Yeah.
We've gotten reams of stuff on disclosure the last year, and virtually nothing on materiality. What you disclose is material. Right? So have we rethought that concept at all?
So I think at least in the UK context, I think issues around disclosure sit with some of the other financial regulators and some of the other authorities. I think what we are doing is obviously having conversations through our supervisory mandates, and that's the review that we're undertaking now of the banking sector, and something that we'd be looking to be publishing in due course. So I think disclosure again is again something that sits outside of our pure mandate as the Bank of England.
There's some interesting questions to be had, debates to be had about materiality, but I think, Bob, you kind of answered your own question, which was that obviously they think it's material, therefore they're talking about disclosure, right? I think. Okay. Hamish at the back.
Thank you. Hamish Stewart, I'm a consultant. I have a question about regulatory divergence. So particularly for the UK and Dutch regulators, what will happen when large banking and insurance entities in those two jurisdictions have to report on climate risk, but not in their home jurisdiction in the US or Canada, for example? How will you deal with companies that are reporting differently on either side of the Atlantic? Thanks.
Sounds like it's for you two.
It sounds like it. I wouldn't treat it any way else as it is today. It's a risk which you could, like I said, see, for instance, in the area of credit risk. So if it is, then of course the nationality plays a role, or the country where a bank is located, where the loan book or the business is located, play a role anyway in the risks which a bank is having. But the way we supervise today won't change because we have added a new way of looking at risks. Because I guess climate risk is just adding, looking at the world in a different way, and you could put that into your whole risk assessment, but it doesn't per se change the way we do things. It's also, if you supervise, you could also look at how you enforce things, but usually we try to start when we supervise to have simply a good conversation with the entities we supervise. And no matter what jurisdiction is, you can also always have a good conversation.
And again, I think from our perspective, the standardization of disclosures, again, sits outside our remit as a central bank. What we are obviously doing is working closely and sharing knowledge with our partners internationally on these issues, so both to capture best practice and to coordinate what we're doing around these issues as a supervisor through the prism of our mandate.
So I've got a question for you. I said I had a few in my back pocket. So do you feel that you have the analytical capabilities and capacity to properly supervise firms in your remit on climate-related risk? And if not, what do you need to do, what do you want to do to get there, and when might you get there for each of the supervisors?
It's a very fair question, I would say. I guess we are building that capacity in terms of quality and quantity. So we have a few good people, and we need to build that capacity. That's why we cooperate together to learn from each other. That's why we are here today as well, and we are supporting this initiative as well. So I think we can learn from each other. We can learn from the sector. The sector can potentially learn from us. So I think we are working on that.
I would agree. It's really a common challenge, both for the firms, the industry, but also for supervisors. And as always, we're interested to make progress in terms of risk management capabilities, of understanding financial risks, models, and so on. And probably it needs an effort from all sides, private firms, academia, supervisors. So we are certainly not in a position to have a much better understanding of risks per se than the industry. We are building upon best practice that is developed by different disciplines, and for us it's important to be part of this discussion, to contribute, to also learn from others, and I think that's the way forward.
So the question then is, and this is of interest to us at Oxford and to people in the room, what are the top priorities then, if to help you do the supervision of these risks properly? What are the big gaps? Well, what are the early priorities for the community to help you? We can come back to it.
Yeah.
I would be keenly interested in seeing what the insurance sector is doing at the moment, because they will have to, or they often have insured some of those big disasters that have happened, that they suffer immediately losses. So they have frequency data on whether the frequencies have actually increased, so whether we are in a world where this happens quicker. We now think that many of the very severe things happen way back in the future, or in front of us somewhere, but they may actually be closer, and that is something interesting and important as well to grasp. This may come at us much quicker than we think, because if you think that it's only going to happen there, the discount factor between the future generations and us is really difficult to sort of grasp and get everybody to do it. But I think the insurance sector is sort of leading, because they have to price that event, and they probably have the best data. I don't know whether you use that in other sectors as well then.
Nick, did you want to come in on this?
Great. Nick maybe from E3G. I've been talking a lot as if the world is going to be quite unmanageable. We're doing orderly transitions to a manageable world in terms of climate impacts and sustainability and the transition technologically. Could I ask the panel to do a thought experiment that if that's not the world we're in? We're all aiming for that, but my job is to be worst case scenario sometimes. So say 2025, countries come up to put their 2040 targets on most of the big economies. Trump too, Trump's been re-elected. And people put on the table something that's pretty much 3 degrees, perhaps 3.5, with some bad climate science. And basically, there's no more time to dismantle. That's kind of committed capital stock, pretty much the trajectories they're going for. What's your responsibility as a financial regulator at that point in both signaling down into the markets about what they should be looking at and signaling up to finance ministers, to parliaments, if you've got that responsibility, about the future of pensions or the stability of the financial system or macroeconomic? Because we know none of the macro models at the moment used by governments or companies contain climate damages, so it's not in the system. So just interested, it's not a commitment, it's just saying what do you think your responsibility should be at that point if that's the scenario we're in, which is not an outlandish scenario?
Okay.
Yeah, so thank you, Nick, for that question. I think some of what you described is obviously motivating the action that we're taking now, right? So again, through our prudential mandate, speaking to firms, engaging with firms on these issues, and then supporting these initiatives to do what we can within our objectives to try and support an orderly transition for the reasons that you outlined. So again, and I think to Ben's question around what we can do, I think that the challenges that we face in terms of looking at climate risk, I guess, are similar to the wider market challenges. So therefore, again, that's why we're really supportive of things that get greater information into the marketplace so that we can then, hopefully do what we can to support that orderly transition.
Anyone else want to come in?
Maybe next to that, I think also the function of doing stress tests is not only to calculate stuff, but also to understand how relations are between things happening and second and third order effects. So you can do, based on real scenarios, stress testing, but you could also do scenario analysis with completely crazy scenarios that you might find yourselves discussing, just to understand what might be the potential outcome of certain areas. And that might help to let's say, put a discussion on the table. And I don't believe that we as a supervisor are the only person or people responsible for doing that, but we might have the tools to at least put those kind of discussions on the table to better understand effects, and therefore also to discuss with the right people what you can do to solve some of those things.
The trick is, the supervisors aren't the ones who are going to do all the work and calculate all the risk and then say invest here. They're supervisors. They're trying to check that things are right, and of course the regulation helps them. Now, this is a market-based system still for a little while before we have dictators everywhere, and this is a wonderful planned economy after that, and then everything comes together nicely. But as long as we are these Western democracies where there is a free will and people want to innovate and they want to invest, the question is how can we make this transparent and the market function better? How do we get these risks priced correctly? The tricky things for supervisors are where there are, somebody wants to somehow do something evil and we can't catch it. So the market doesn't function properly and somebody misuses that. Or there are those parts of the financial sector that are so close to, like the financial intermediation through the banks, so close to the rest of the system that everything goes if that goes. So those tricky parts are particularly difficult, but I think you can hardly blame the supervisors if the heating up of the system is more than what we expected. But there is indeed something that we have to get straight, and that is how to make this transparent. How can we assess things? How do we know if it's getting quicker? Somehow we have to get grasp of that, but that shouldn't be the one driving us thinking that, well, if it's lower, we don't have to do anything. We now know that this is a problem. We have an effect on the environment in a way that actually shouldn't take place. We are doing too much and probably killing ourselves in the process. So clearly the data is the key. Now making that data so that it's material, that we understand it and we can set a price to it is the trickiest thing. Because we can disclose as much of things as we want. But in the end, whether it affects the models, we can put a figure where we say that the risk is this much. Now, risk and uncertainty are two different things. Risk is about putting a number and uncertainty is not knowing. Unfortunately, we are still in an uncertain world where we can't put the figure there. And that really bugs me because I can even think that the financial sector systemic risk is easier to solve than this to put a figure on it. But we shouldn't give up or shouldn't slow down just because it's difficult.
Oh, you wait to this moment to clarify.
Go ahead. So the question was, what do you think your responsibility is? I'm not asking you to take all responsibility, but one of our jobs is to work out what's broken in the system. So if there is a 3.5 degree scenario, who else's responsibility is it to communicate that into? So are you looking for the finance ministry, or I'm just trying to work out how the system works at the systemic risk level, because you admit this is a systemic risk level of climate change. And you have responsibilities in your roles, which are different because you're in slightly different roles. But also, who do you look to, if it's not your role to communicate something about the impact on pensions, etc., whose job is it in your system? It's about kind of just trying to work out if it's somebody's job, or if we have to create a place where that job is held. I'm not saying it has to be your job. That wasn't the question.
A one-word answer then. Whose job is it in your respective systems? Starting with Leena. Whose job is it?
It's only one word. Already too many, but I must say it has to be quite many more people than us only, regulators and the supervisors in the financial sector. Because the market won't be able to price risk correctly if we are subsidizing things that are harmful for the environment by the government. So the same government that gives us the role to supervise the system, if they don't follow their own rules and this is not consistent, there are a lot more people on the line, and some of them are, more first in line than the supervisors, because you can only do so much with the financial sector supervision. And the pricing of risk has so many other things as well affecting.
So that's the government's job.
Yeah.
Yeah, Rupert?
Well, I think for us it's really making sure that financial firms, the supervised entities, are addressing their risks properly, and the risks are clearly, I think, defined: market risk, credit risk, legal risk, operational risk, and we expect that they are applying, to the best of their knowledge, the best practice. So I think we as supervisors, we cannot really say this pricing is wrong, here's the correct pricing, because that's not our role, to define the prices. We have to check the processes, we have to check the knowledge they are applying, and of course we have to second guess. We can see if there are deficiencies in the models, if there are inconsistencies and so on. But I think it's not our role as a supervisor to set the market price. So the market should bring up the correct price. And if there are market failures, then of course we as a supervisor, we can make proposals to the regulator to intervene. And this means concretely more transparency, maybe mandatory transparency or disclosure. But there our role then would say would end.
So it's the government's job or the regulator's job, or you seeing the regulator as an arm of government? I suppose you are.
Well, for example, for mandatory disclosure, that would be the Ministry of Finance and the government to regulate.
Okay, Ministry of Finance.
I think there's obviously a range of actors involved. I'm not going to answer the question directly and try and pin out exactly who's doing what. I think for me, what is a really interesting area is how do you make these risks more transparent and particularly forward-looking climate scenarios. So I think, there's a whole question there of if we do have these longer-term risks, this really speaks to this tragedy of the horizon, then how do we make those transparent to those who are responsible? So I think that for me would be the area an area of real innovation that will require the cross-sector support of people in this room and has great potential.
Okay. Tom.
Hi, Tom Harrison, Sainsbury Family Trusts. So last year I ran a survey of fund managers in the UK, asking them what year do they think that the oil and gas companies will be revalued significantly. They said 2020 to 2025, right? So that's soon. Peabody went from the darling of the company with huge investments down to crashing in like 2 to 4 years, right? So we're at the start of the point where the oil and gas companies may well fall down. Yet the fund managers who say there's this risk haven't yet provided any products for pension holders to invest in a way that avoids those risks. So what action can we take now to make the fund managers at least create the products to make the marketplace more effective?
That old chestnut.
Well, it's a challenge to go through the books of all pension funds, I would say, and to see how they invested piece by piece. So that's too big a challenge. So also here, I guess it all starts with the financial sector, and in this case, the pension fund, for instance, who gives the assets, the investors the role to invest for them. So there it all starts. Our job is, I guess, to challenge that, to question whether they are right, to question whether they have captured all the risks. And then there ends our role. If we do see that our mandate is not enough to do our work well, and that's something we have to investigate further when it comes to climate risk, and that's why we cooperate together, then in our case, we should go to the Ministry of Finance and ask for a better mandate in this case. But we need then to have evidence and proof and a story what we really need to have to be able to do a better job in challenging or asking, for instance, pension funds to make a better risk assessment. And we are not there yet.
Does anyone else want to come in?
Yeah, I'm sort of struggling a bit whether I grasp exactly the role of regulators in this sort of arena. So what to do if there aren't investment opportunities to balance out the risk, then it's hardly the regulators who do that. But I've been wondering whether the innovation system is functioning at its full potential, and whether the disruptive things that come up are disruptive enough, or are they just evolutionary? Do we have to do things in this manner that we do now? I mean, somehow there is a danger that something is not right with the way we innovate and invent new things. Now, whether it is the accumulated monopoly power or whether something else, but somehow this corporation system is not as efficient, and it doesn't provide necessarily so interesting new opportunities. Now, pension funds are tricky, and I often wondered about this, particularly in the case of Finland, where we have very large pension funds. They have to be rather sort of careful in their investment policy. They aren't the first ones to throw equity at all sorts of new things. So the question is whether there is also a wide enough variety of different investors with different pockets who dare to take the risk, because the startup phase is so very, very likely to go amiss, and you'll take a lot of failures and hits before you get anywhere. So whether we've grown so big and lazy, and everybody is so careful with their risk-return profile, that we just aren't too keen on taking risks, no matter what incentives there are on supervisory regulatory side. I don't know if you can push them. And this monetary policy has been interesting in the sense that it has forced rates very low, and it has forced people who don't want to hunt yield to go elsewhere to look for it, because they need to get their returns from somewhere. So now really in this situation, saying that do this and you get the market to function better, I don't think we are there. But I do find it interesting, and this is a bigger topic than financial sector regulation or what supervisors do, or whether the innovation system functions, whether the monopoly powers have increased too much, whether this is efficient way of creating new and disruptive things, and are there investment pools that are willing to take or can take the risk? Their size allows it. A lot of the questions that I daily wonder about, but the data isn't there yet to really say one way or the other. But I'm not sure that the financial regulation is solution to everything. I think it's not a hindrance now to invest in risky things, and yet there is risk aversion in the system that just doesn't necessarily want to do it. And the innovation is low, in my view.
Okay, any other questions? Yeah.
David Clark from Luxembourg Institute of Financial Integrity. Question, what role do you see in the future for rating agencies and central bank eligibility criteria, which in the past, in fact even today, drive a lot of financial market pricing?
May I bail out the central bankers in the panel?
I think that'd be a good idea.
They don't having to reply to that. Now, central bank's original role was to be responsible for the nominal, so price stability. So I think thinking about the eligibility, it has to be very secure, very, good collateral to have there. And potentially now talking about the innovation, these new innovations where we solve some of these really tricky problems and get rid of some of those exposures that we have, very sort of brown sectors, as we would like to think. They may be so risky that I would never put central bank's money there. It has to be the direct investor doing it. The rating agencies, through the risk analysis like described with the banking sector, in that case, the systemic risk somehow being taken into account in their ratings is useful, although I understood that before they didn't price all the risks. They should now definitely do the systemic. But how they do that and what the taxonomy is extremely tricky, because you don't want them to do wrong things, because they then lead to investors. So,
yeah, and I would just add, I'm not going to comment on any sort of monetary policy aspects of that, but clearly credit rating agencies have a really important role to play, and we're seeing a diversity of practice begin to emerge, obviously, in terms of them beginning to integrate some of this thinking. So I think just as any other actor, I think credit rating agencies integrating these things is going to be important.
I would also agree, and I think that's one of the lessons from the last financial crisis, that we need to improve the processes, the methodologies, the transparency around ratings. We should also avoid some sort of over-reliance on external ratings, and financial firms should do their own assessments. That's what we require and expect. But potentially, I think rating agencies are just one of those agents in the financial system that can have a positive role here, because they have a role when it comes to pricing, to providing information, and the information should be as reliable as possible.
Okay, so we're approaching the end. I mean, I think we should all give a huge amount of credit to the regulators for signaling to the market and to all of us that this is an important issue. We would be not where we are today if it wasn't for the Bank of England and others coming in and flagging this as an issue and spurring serious considered thought on these topics from a wider range of different stakeholders. So thank you for that. But clearly there is a long way to go, and each of you will develop, I hope, or have developed, I hope, some sort of roadmap internally for how you will operationalize this theory and turn it into reality within your own organizations. How do we effectively manage these risks within the system? So the final question for each of you is, can you identify one kind of barrier to you doing that, and I guess, you know, suggest how we might be able to help the community, because this is the whole point of this, is in part, in large part, to try and innovate together. So I don't know who wants to start first. Leena, you could start first maybe.
Yeah, sure. I think I said this already, but I think in order for the financial sector to properly do its job, it will need to be corrected the system from other places as well. So I'm not saying that correcting the financial sector and trying to give its incentives are, you know, redundant. No, you have to do that, but you have to know that if there's anything that makes something lucrative, on the other hand, that what we are doing, then that's what they will be chasing as well. So it's a tricky thing. So I would say this biggest barrier to getting this right is that we have contradictory policies within the government. So it's not always Ministry of Finance responsible for everything when there are other agendas as well. And here we come to the issue of intergovernmental cooperation, that we agree together to get rid of the certain subsidies, for example, is extremely important.
Great, thank you. Rupert.
Well, I think this is a global challenge, so we certainly need a globally coordinated response. I think there's a role for us as supervisors to cooperate and really to exchange our experience, but also to really, combine our efforts.
Thank you for the kind comments on the bank's role, and obviously we've been doing that very much with others as well. I mean, I would say, you know, again, to your points, we have made progress on these issues. I think there's barriers that we've recognised that are barriers to the market more broadly around this, like information and so forth, which is obviously why we have things like the Disclosure Task Force and other initiatives in that space. I think there's barriers around the importance of working together and having a coordinated approach, which is why we're having networks and other gatherings like that. And I think there's, you know, barriers still in terms of going through our own process of obviously raising awareness of these issues amongst the supervisory community. So I think just as there is a transition in thinking happening in the marketplace, I think there's a broader transition in thinking, you know, and the capacity building other elements that go with that.
Thank you. You have the last word.
Yeah, well, I think the sustainability we have discussed today is a big challenge for everybody, and I guess it was very nice for me at least to share our ideas with you, but also to learn from you and to see what you are struggling with and seeing as challenges. And it seems that we have a lot of common challenges to face together. And I guess that's also how the role play should go in the end. Everybody has to play a role in that. The financial sector needs to do that, but we as a supervisory community have to do this as well. And it's nice to share that together with you, but also with networks like this one.
Well, thank you very much. We're clearly all trying to figure out these different things. We're making progress, but thank you. Okay, so we're now into the final countdown. I'm not going to do a big long wrap up. Sylvie, okay, you're going to be on a call. For no longer. Anyway, so I'm going to just say a few words at the end, and then we're also you're going to hear from the organizers, the hosts of the next conference next year. But I'll do some thank yous first before handing over. So obviously, I want to thank you all for coming, and some of you from way away, I suppose, not that far away, not like you've been coming from China or the US, but, for crossing over and flying into cold London, and for giving up your time. I particularly want to thank the speakers and the chairs. And I also want to thank the funders that made this happen, so the European Climate Foundation and the Finance Dialogue. Thank you for your support. I also want to thank the City of London and its Green Finance Initiative for providing this venue. It's a very nice venue at the heart of, in the heart of the city. And then a bunch of people that have made this happen, some of whom you will have seen, but I wanted to name two people in particular. So Fran and Patricia that have done a sterling job making this all happen. So thank you to them in particular. Now, this partnership, it's a bottom-up thing, really, and this is the start of something, we hope, and we're very excited about it. But it will entirely depend, its success, its relevance, its future will depend on your organizations and you as individuals being part of it, and we're here to help. The Secretariat's here to help. We've got a number of things underway. We can support other things. We obviously have the conference next year. But I think this shared ambition is an exciting one, and one that we should really jump on and make our own. I think in particular the idea around learning from each other and how we do that effectively, and the different ways in which we could do that, something to dwell on, and something particularly as a university at Oxford we will think about as well. And throughout all of this we should just consider what we can collaborate on before it gets competitive, that sort of pre-competitive collaboration. If you want to join the organizing committee or be more involved, this is, again, all about volunteering and being engaged, being part of the community. So you'd be very welcome. So talk to me or to Sylvie afterwards. This conference is it's explicitly actually about bringing together the usual suspects. I mean, a lot of the convening we do is not about bringing together the usual suspects, it's about bringing new people into the conversation, but this is about mobilizing the usual suspects in our different communities. So hopefully that was useful. We're going to have drinks and dinner, not here, but 3 or 4 minutes away. We will form a convoy, I suppose, follow me, and you'll get there. It's very close by. And I hope you can stay for drinks and hopefully for dinner as well. But I'm now going to hand over to, drum roll, exciting, eh? Where is Luca? Go, Luca. Do you want to say a bit about, you've just emerged, okay. Exciting. Here we go.
Yes, well, first of all, let's thank also Ben for organizing all of this. So thanks for that. So since it's the Northern European Partnership, next year you'll come a bit more north, and we will welcome you in Stockholm, if you may want to come. We are setting the date on the 14th of May, which is when things start to melt and gets a bit nicer. We get maybe some leaves, green leaves on the trees. I think today has been fantastic, of course. There are a lot of these kind of events, but I think there is value still to come together. We've heard from the various panels. I think there is going to be, the sense of urgency is there a little bit. We've heard some of the bottlenecks, the problems, the barriers. I hope next year we can, have removed at least a couple of them and hear some success stories together with maybe the next wave of barriers. But again, Stockholm will welcome all of you and maybe some more. We'll see how many we can gather. The Stockholm Center, Sustainable Finance Center will host it together with probably some other Swedish corporate, maybe bank, SEB, is probably getting involved in organizing as well as the Swedish House of Finance and possibly WWF. So that's part of the core organizing team, okay? So with that, I'll stop. I think we all deserve some drinks after the discussions today, but welcome next year.
Okay, onwards and upwards. It's somewhere over that way. Thank you.